Welcome to the Finance Abridged Digest for the week ending April 3rd, 2026. Here are the top ideas you should know about from this week's review. First, the traditional 60-40 portfolio is structurally failing under the weight of physical supply shocks, so you need to reassess your fixed income allocations. Second, if you have any exposure to private credit, you need to audit that immediately because shadow banking funds are actively gating withdrawals. And third, the smartest money is moving into cash and physical commodities to build a highly defensive wartime portfolio. We've got a couple of massive open loops to close on all of this.
Yeah, the underlying mechanics driving these shifts are just, well, they're wild to look at up close.
Quick reminder, nothing in the show is financial advice. We don't know your situation, your goals, or your risk tolerance. We're here to break down what the experts are saying so you can make your own informed decisions.
Right, exactly. So let's just jump right into the data.
Yeah, and the mission for our deep dive today is to really bridge this terrifying disconnect we're seeing. Because right now, out in the Strait of Hormuz, global shipping has basically ground to a halt. I mean, missiles are actively flying.
Yeah.
Energy infrastructure is literally burning. But if you pull out your phone and look at the S&P 500 or the Russell, you'd think we're in this era of just unprecedented global peace.
It is the ultimate cognitive dissonance.
Yes.
You have the physical world on one side, where moving a cargo ship actually requires like insurance and fuel and a safe physical passage.
Right.
And then that is just completely colliding with the digital reality of the stock market.
Yeah.
Where algorithms are just trading on sentiment, at the speed of light. And right now, those two realities are just entirely divorced.
And bridging that gap is our goal for you today. We have this massive stack of sources we're pulling from granular macro analysis, geopolitical scorecards, and some really sobering data on the shadow banking sector.
Because if you're just watching the ticker tape, you are missing the structural fractures underneath. The machines trading these stocks, they're completely blind to physical supply chains. But the physical supply chain always gets the last word.
Exactly. Now, before we go any further, I do need to share a mandatory disclaimer with you. Our sources today contain some highly politically charged commentary.
Oh, heavily charged.
Yeah, they discuss the Trump administration, the Biden administration, Fed Chair Jerome Powell, foreign entities like Iran and Russia. We are looking at this purely through the lens of market mechanics.
Right.
We take absolute no political sides. We are simply reporting how the sources analyze the impact of these forces on the global economy.
Because the market structure itself, it doesn't care about ideology.
Yeah.
I mean, it only registers supply, demand, liquidity, and leverage. So our job is just to isolate those variables.
Keeping that strictly in mind, here is the core hook. We spent all this time worrying about like a stock market bubble or a real estate bubble, but the sources suggest the most dangerous bubble right now is actually psychological. It's this assumption that the physical world can just be controlled by financial engineering.
And that is basically the defining tension of this entire decade. We're operating under this illusion that printing digital money or, tweaking interest rates can somehow instantly solve a physical molecular constraint.
Right. Like, let's trace how that illusion plays out on Wall Street. We see these chaotic, news-driven rallies. Someone posts something on social media about the Middle East, and seconds later, the market just surges.
Yeah, it just rips higher.
Why is the financial sector treating a conflict in a major shipping lane like some minor administrative hurdle?
Well, you have to look at the trading strategies dominating the floor right now. Wall Street is currently obsessed with this thing called the Trump Pressure Index.
Okay, what is that exactly?
So it was actually formalized by Deutsche Bank's head of cross-asset strategy. And it's fascinating because it completely ignores traditional fundamentals, like it doesn't care about corporate earnings or PE ratios.
So what does it actually track?
It tracks 4 very specific metrics: the 1-month change in approval ratings, 1-year inflation expectations, the performance of the S&P 500, and U.S. Treasury yields.
Wait, so it's essentially just a dashboard for political pain?
Precisely.
Yeah.
The working theory here is that these are the 4 metrics the administration monitors the most. So when inflation expectations tick up and the stock market ticks down, the pressure flashes red. And traders are using this to execute a strategy known as TACO.
TACO?
Yeah, it stands for Trump always chickens out.
Wow. That is an incredibly cynical way to trade.
Oh, it's entirely cynical, but I mean, it dictates billions of dollars in capital flow. The traders doing this, they aren't betting on a genuine peace agreement based on like actual diplomacy.
Right.
They're buying the capitulation. They assume the administration will just back down from any hardline stance. The absolute second the stock market threatens to drop, they're basically front-running a bailout.
It honestly reminds me of a rebellious teenager. They keep pushing the boundaries, staying out past curfew because they know their parents won't actually ground them. The parents always cave.
Exactly. The market thinks, well, the administration will save us, the Fed will pivot, they just can't afford to let it crash. But the sources point out that it goes way deeper than just human traders betting on psychology.
Yeah, the actual architecture of the market is driving this, right? Because human traders are almost a minority influence now.
Oh, a massive portion of daily movement is just algorithmic. Like, let's look at CTA flows, commodity trading advisors. Despite the name, these are massive quantitative funds that just employ systematic trend-following algorithms.
So they aren't reading the news about the Strait of Hormuz?
No, not at all. They look at moving averages. If an index crosses above a 50-day moving average, the algorithm just automatically buys, which creates this self-fulfilling upward momentum.
It's blind momentum. The algorithm sees green, buys more, makes more green. But what happens when you combine that with structural expirations, like the sources mentioned that massive JP Morgan options collar? How does that distort things?
So an options collar is a hedging strategy. JP Morgan's hedged equity fund holds tens of billions in stock. To protect against a crash, they buy put options, which is like insurance. But to pay for that, they sell call options, which caps their upside.
Okay, so it creates a defined range.
Right, a collar. And because the position is so astronomically large, the market makers on the other side have to constantly buy and sell the underlying stocks to stay neutral. This basically pins the market and suppresses volatility.
But what happens when that collar expires?
Well, when it expires or rolls over, that pinning effect vanishes. The market makers suddenly have to adjust their hedges, and that unleashes these wild, erratic swings in price that have absolutely zero to do with the real world.
And then, layering on top of that, we have this explosion of 0 days to expiration options, the 0 DTE stuff. For someone who doesn't trade options, why is that so uniquely destabilizing?
Traditionally, an option gives you the right to buy or sell a stock, say, 3 months from now. It was for farmers hedging crops or funds hedging long-term risk. A 0 DTE option expires at the end of the current trading day.
So it's literally just a hyper-leveraged lottery ticket.
Exactly. Because it expires in hours, the premium is incredibly cheap. Retail and institutional traders are buying them in massive volumes. But structurally, when you buy a call option betting the market will go up today, the market maker who sold it to you assumes massive risk.
Right.
So to hedge their own book, they're forced to go into the open market and buy the underlying stock immediately.
So if a million people buy these 0 DTE calls on a whim, the market makers are mechanically forced to buy billions in stock, driving the price up, divorced from any real news.
Yeah, it creates a feedback loop called a gamma squeeze. And this speculative frenzy is peaking right now. One source pointed out that people on prediction markets, like Polymarket, are now placing leveraged bets on 5-minute crypto price movements.
Betting on what a coin will do between 2 p.m. and 2:05, that's just the gamification of capital.
It is. It's an algorithmic environment creating a systemic false sense of security. The machine doesn't care if an oil tanker is burning in the Persian Gulf. It only cares about the strike price at 4 p.m.
That is genuinely a chilling realization, because while the algorithms are playing this digital game, the physical X-ray of the global economy is showing compound fractures. So let's transition to the physical choke point, because the news always focuses on crude oil, right? Brent crude hitting 110 a barrel.
Sure, yeah.
But the sources suggest oil might actually be the least of our problems.
Logically, oil is the most solvable part of a disruption. Crude oil is highly fungible.
Meaning a barrel of oil is mostly just a barrel of oil. You can pay a premium and get it from West Texas or Canada.
Exactly. It hurts your wallet, but the engine runs. But the Strait of Hormuz is a choke point for specialized commodities that cannot be rerouted. Let's look at LNG, liquefied natural gas. Qatar is an absolute behemoth. They produce a fifth of the world's LNG.
And the reports confirm their Ras Laffan facility took a direct missile strike. The Qatari energy minister estimated 17% of their total capacity was knocked offline. And they're saying 3 to 5 years to rebuild. Why half a decade?
Because of the mechanics of LNG. You don't just pump gas into a metal tank. You have to run it through a massive liquefaction plant, a train, which cryogenically cools the gas down to negative 260 degrees Fahrenheit.
Oh, wow.
Yeah, so it shrinks to 1/600th of its volume. These facilities are marvels of cryogenic engineering. Every valve and heat exchanger is custom machined from specialized alloys.
You can't just buy parts on Amazon.
No. If a missile destroys a train, you start from scratch. You re-engineer, resource, rebuild. That 17% hole in global energy is going to be open for years.
And it gets even more granular. Let's talk about helium. 33% of global seaborne helium passes through this exact strait. Most people just think of party balloons.
Right, but its industrial applications are mission critical. Helium is a non-renewable byproduct of natural gas extraction. You can't synthesize it, and it has the lowest boiling point of any element in the universe.
Which is why it's used for cooling superconducting magnets, right?
Exactly. MRI machines, but more importantly, semiconductor manufacturing. The lithography machines that print microscopic circuits generate immense heat. Without a steady flow of liquid helium, the semiconductor supply chain just stops.
So if plants in Taiwan can't get helium from Qatar because the strait is blocked, they can't make the chips that power everything from phones to military hardware.
Yep. No synthetic substitute.
And then there's agriculture. A third of all seaborne fertilizer, a quarter of global aluminum. Fertilizer production relies heavily on natural gas, so the price is skyrocketing right as Northern Hemisphere farmers start spring planting.
And the downstream effect there is profound. The World Food Program is warning this specific bottleneck could threaten global food security by 2027. If farmers can't afford fertilizer today, crop yields collapse tomorrow.
And diesel. The sources consistently call diesel the true physical engine of the economy. It runs at the combines, the trucks, the freight trains, but places like California and Australia are hyper-exposed.
Yeah, because over the last decade, due to environmental regulations and green initiatives, California and Australia systematically shut down their domestic oil refineries. They decided to rely almost entirely on importing refined diesel from mega refineries in Asia.
Okay, but those Asian refineries rely on crude oil from the Middle East, so if the strait is blocked, the Asian refineries run out of crude, and they stop exporting diesel to California.
And if those ships stop arriving in Los Angeles or Sydney, you weren't just looking at higher prices at the pump, you were looking at physical rationing within weeks. The logistics networks that deliver food to grocery stores would literally freeze.
I want to push back on that apocalyptic timeline, though, using the market's logic. Let's assume the taco theory is right. The administration caves, they get a peace deal by April 6th. Why can't they just turn the oil wells back on, clear the ships, and get back to normal by May?
That is the exact assumption driving the stock rally, and it shows a total ignorance of petroleum engineering.
Yeah.
You cannot just flip a switch like a kitchen faucet. When storage tanks fill up because ships can't enter the Gulf, the wells have to be shut down. It's called a shut-in well.
Okay, so walk us through the mechanics. What happens underground when you stop the flow?
So deep underground, crude oil is incredibly hot. As it travels up the pipe, friction keeps the temperature elevated. But when you shut the well in, the crude sitting in the miles of piping and the surrounding rock, begins to rapidly cool.
Okay.
And crude oil is full of paraffins. When they cool, they solidify. The crude becomes waxy and highly viscous.
Kind of like bacon grease cooling in a frying pan.
Exactly like bacon grease. It literally clogs the microscopic pores in the rock. It's like an artery clogging with cholesterol. And to protect these wells from blowouts during the missile strikes, engineers had to deliberately seal them with heavy drilling mud or solid cement plugs.
Wait, they cemented their own wells shut?
They had no choice. It's standard safety protocol in a war zone. But you can't just dissolve cement. Those plugs have to be painstakingly drilled out by specialized rigs. And if you try to force the pressure back too quickly to clear that waxy buildup, you risk fracturing the rock in the wrong direction, bypassing the oil, and ruining the well permanently.
So bringing a shut-in well back online takes months.
Months of delicate engineering. And that assumes the ships can even get to the ports.
Right, because of the naval gauntlet?
Yeah. Even with a peace treaty, the strait was heavily mined. A piece of paper doesn't magically sweep thousands of miles of ocean for explosives.
Because no maritime insurance company is going to underwrite a policy for a vessel in that zone.
Exactly. No corporate captain is sailing a multi-million-dollar vessel full of explosive gas into an unswept war zone. Plus, Iran is demanding a $2 million safe passage fee per vessel. Negotiating that logjam will take many months.
This brings us to a really fascinating macroeconomic argument. Mainstream economists on TV are constantly reassuring people that we don't need to worry about a 1970s-style energy shock because our oil intensity has collapsed.
Oh, it's their favorite talking point. They say, well, in the 70s, it took one full barrel of oil to generate $1,000 of GDP. But today, thanks to tech and efficiency, it only takes 0.4 barrels.
So they say we're immune.
Right, but the sources shatter the solution. It's a statistical mirage. We didn't reduce our vulnerability, we just played a massive shell game and moved it.
Yeah, let's unpack where we moved it. First, to embedded energy, which perfectly explains the inflation piece of the puzzle.
Think about the physical goods the U.S. consumes. Electronics, appliances. We don't manufacture most of that domestically. We import it from Asia. But forging that steel and molding that plastic requires astronomical amounts of energy.
So we aren't directly burning the oil, but we are importing the physical result of that burned energy.
Precisely. So when energy costs for Asian manufacturers skyrocket because the strait is blocked, they pass those massive costs directly into the wholesale price of the goods. We import their energy inflation.
And the other place we shifted the vulnerability is our domestic power grid. This ties directly into the AI squeeze. It's super ironic because the tech sector, the Magnificent Seven, is basically the only thing holding up the stock market right now.
Right.
Because AI is the future. But that entire digital sector is existentially dependent on physical infrastructure.
They depend on hyperscale data centers.
Yeah.
And the computing power required for generative AI is exponentially higher than traditional cloud computing. The International Energy Agency predicts that by 2030, global electricity demand just from new AI data centers will grow by 50 gigawatts.
And the sources note that 50 gigawatts is enough to power the entirety of Germany and France combined, just for computer chips. But how does that connect back to the Middle East choke point?
Through the marginal cost of electricity. In developed nations, base load power is nuclear, coal, or hydro. But when demand surges, the grid relies on peaker plants, which are almost universally powered by natural gas. So natural gas sets a marginal price for electricity. When 17% of Qatar's LNG goes offline, global natural gas prices surge. That hits the power grid, increases the operating costs of AI data centers, and hits the bottom line of the tech sector, holding up the stock market.
Which perfectly explains why all these major AI companies and tech billionaires are suddenly panic investing in nuclear energy and physical uranium assets.
They are looking at the math and realizing how fragile the natural gas supply chain is. They are recognizing a strategic failure that nations are only just now admitting to. Over the last decade, places like the EU and Germany phased out nuclear power in favor of wind, solar, and imported Russian gas.
And now they're publicly reversing course.
Because intermittent green energy can't provide the steady-state, ultra-reliable baseload power required for a hyper-digitized economy facing supply blockades. They're pivoting hard back to uranium.
Why uranium specifically over natural gas?
Because of energy density. Natural gas requires a just-in-time supply chain. Pipelines, LNG tankers. If the pipe is severed, the plant shuts down in days. But uranium, you fuel a commercial reactor, and it runs at full capacity for 18 to 24 months without refueling.
It's basically a 2-year immunity shield against geopolitical choke points.
Exactly.
So we have a market rallying while the physical reality shows clogged wells, no helium, and a massive AI power drain. Let's look at how this macro breakage trickles down to the individual consumer and how the central bank responds.
Well, this is where theory meets reality. The American consumer is just fundamentally exhausted.
The data points paint a very bleak picture. During the peak of COVID, with stimulus checks and nowhere to go, the personal savings rate hit an all-time high of 32%. But today, it has plummeted to 4.5%, and it's still dropping.
The emergency cushions are vaporized, people are sustaining their lifestyle on credit cards, and these supply-driven price increases at the gas pump are eating away whatever tiny margin they had left.
And this consumer exhaustion is colliding with a massive warning signal from the bond market. The sources focus heavily on the 2-year Treasury yield, violently jumping above the Fed funds rate. For a listener who doesn't watch bond yields, let's break down why that inversion is flashing red.
So the Fed funds rate is the overnight rate set explicitly by the Federal Reserve. It's a mandate. But the 2-year Treasury yield is set by the open global market. It represents what investors demand to be paid to lock up their money for 24 months.
It's the market's collective projection of the near future.
Exactly. Since 2023, the narrative driving the stock market was that inflation was conquered and the Fed would cut rates, a dovish stance. But when the 2-year yield surges past the Fed funds rate, the bond market is effectively calling the Fed's bluff.
They're saying, we don't believe you can cut rates.
Right. The market is saying the inflation imported from this energy shock is too deeply entrenched. You are going to have to shift to a hawkish stance and raise rates again.
And this catches Jerome Powell in what the sources call the dual mandate trap. He has to keep prices stable and maximize employment. But right now, his tools contradict each other.
If he cuts rates to provide relief to the exhausted consumer, he instantly stokes the inflation fire higher by weakening the dollar. But if he raises rates to crush the energy inflation, he bankrupts businesses and crashes the stock market.
The analogy I keep thinking of is a homeowner standing in their kitchen watching a massive grease fire erupt on the stove. And their only tool to fight it is the thermostat on the wall.
Oh, that's perfect.
They try to put out the grease fire by turning up the air conditioning in the living room. It targets the completely wrong mechanism. You can't cool down a chemical reaction with ambient air pressure.
That is exactly the Fed's dilemma. Jerome Powell can print digital dollars. He can tweak the cost of borrowing. But he cannot print a single barrel of refined diesel fuel. He can't print cryogenic valves for an LNG plant. Monetary policy is entirely impotent against a physical supply shock.
But the sources point out the Fed hasn't just been sitting idle. The data shows that since December of 2025, they have quietly printed roughly $130 billion to purchase primary dealer assets, mostly U.S. Treasuries.
It is quantitative easing by stealth. With inflation still a problem, they should be shrinking their balance sheet. But the federal government is running massive deficits. They have to issue massive amounts of debt.
And the open market is demanding higher yields to absorb it.
Right, so to prevent interest rates from spiraling completely out of control, the Fed steps in as the buyer of last resort, printing money to buy the government's debt.
So it's pure monetization of federal debt. For the retail investor, the person holding a standard retirement account, what does this mean? Our first actionable takeaway was about this.
It means the classic 60-40 portfolio is officially dead.
60% stocks, 40% bonds.
Right. For 40 years, bonds were the ultimate hedge. If stocks went down, central banks cut rates, bond prices surged, and it balanced out your losses like a seesaw.
But in a world driven by physical supply shocks and structural inflation, the seesaw breaks.
Completely. Because inflation systematically destroys the purchasing power of fixed-yield bonds. If inflation is 5%, a bond paying 3% guarantees a loss of wealth. So instead of balancing each other, stocks and bonds both fall simultaneously.
There is nowhere to hide in traditional paper assets when the currency is being debased, which perfectly explains where the actual systemic breakage is starting. If the consumer is tapped out and the Fed is strapped, where are the bodies buried? The sources point directly to shadow banking.
Yeah, we really need to look at Michael Pento's framework here. He outlines the triumvirate of bubbles. He argues we are dealing with simultaneous historic bubbles in credit, real estate, and stocks.
Just to contextualize the sheer scale of the leverage, total equity market cap is over 200% of U.S. GDP. Anything approaching 150% is historically wildly overvalued. Business debt is at $22 trillion, which is 70% of GDP.
And that 70% figure is exactly where the corporate sector peaked right before the 2008 global financial crisis.
Pento calls it a debt-disabled economy. It carries so much debt, it can't tolerate a marginal increase in interest rates. And the absolute weakest link is private credit.
The shadow banking meltdown. This is the most opaque sector of the financial system. Private credit is when non-bank entities, mega funds and private equity, lend directly to businesses.
Highly leveraged, risky companies.
Often software or tech companies whose balance sheets are too weak for traditional bank loans. They're basically subprime corporate loans. And the default rate in private credit has officially hit 9.2%. Again, exactly the default level during the darkest days of 2008.
But the real drama is unfolding within the mega funds themselves. The sources detail the situation with Apollo's private credit fund. It's the perfect case study.
It really is. Apollo recently received a wave of withdrawal requests. Investors saw the macro environment deteriorating and wanted their cash out. These requests represented 11.2% of Apollo's massive $15 billion fund.
And Apollo simply said no. They erected the gates, enforced a strict 5% cap on redemptions. Investors were legally trapped. But the most absurd part is the payout for the small fraction they did hand back. They only gave exiting investors 45 cents on the dollar.
A 55% haircut, just to access your own capital. And the hypocrisy is staggering, because just weeks prior, executives from these exact funds were on TV claiming their portfolios were pristine. They officially claimed on their balance sheets that their assets were marked at 100 cents on the dollar.
I have to trace the logic here because it feels entirely contradictory. If they are legally claiming their loans are worth 100 cents on the dollar, how is it permissible to only hand back 45 cents to an exiting investor?
It comes down to the critical difference between mark-to-market and mark-to-model. These loans are bespoke, illiquid contracts. They aren't traded on a public exchange. There is zero true price discovery.
So the fund managers just decide what the loan is worth.
Yes, they use internal mathematical models to value their own assets. It's the ultimate fox watching the henhouse. A manager looks at a loan to a struggling company and mathematically justifies marking it at $1. But when an investor demands physical cash, the illusion shatters. The fund doesn't have the cash, and they know they can't sell that garbage loan in the real world for $1, so they penalize the exiting investor.
And the regulatory evasion gets even more twisted with what the sources call the secondary market game. To prevent a full-scale run, these shadow banks create engineered off-ramps.
Right, if an investor is desperate to get out, a related fund, like a cousin fund managed by the same umbrella corporation, steps in and offers to buy their shares for, say, 25 cents on the dollar.
The panicked investor accepts it because they just want some liquidity. But here's the magic trick. The cousin fund, which just bought the asset for 25 cents, places it on their balance sheet and continues to value it at 100 cents on the dollar.
Yep. So the cousin fund instantly claims a 300% paper return. And crucially, the asset manager gets to keep collecting management fees based on the full fantasy valuation.
It is a complete black box designed to avoid price discovery.
But it's just a delay mechanism.
Oh.
It can't last forever. History shows credit cycles always break from the bottom up. Subprime auto, commercial real estate, private software debt. Once those default, it metastasizes upward into investment-grade bonds and eventually brings down the equity markets. That 45-cent payout is the canary in the coal mine suffocating.
So, if the internal organs of the Western financial system are quietly failing, how is the rest of the world reacting? Let's look at the macro geopolitical chessboard and how capital is moving in an era of deglobalization.
We have to look at the geopolitical scorecard compiled by the analysts. Who are the winners and losers? The results will shock people who still view the world through 20th century alliances.
Right. Let's start with the winners. Bizarrely, Russia is emerging as a massive economic beneficiary.
Because the global energy market is balanced on a razor's edge due to the Strait of Hormuz, the U.S. was forced into a massive strategic retreat. To prevent a domestic energy shock, the U.S. temporarily lifted sanctions on roughly 140 million barrels of Russian oil stranded at sea.
They lifted sanctions on a geopolitical rival just to prevent gas prices from spiking.
It establishes a new rule for the 2020s. Maintaining domestic market stability will absolutely override long-term foreign policy. The U.S. couldn't afford to keep that oil off the market, so Russia received a massive cash infusion.
And the other undisputed winner is China.
China is largely insulated from this specific shock. They rely on domestic coal for baseload power and aggressively pivoted to renewables. So while the West scrambles for LNG, China is utilizing the chaos to aggressively purchase physical commodities, specifically physical gold.
And they are funding those gold purchases by systematically selling off their U.S. Treasury bonds. Now let's flip the scorecard to the losers. The United Kingdom is flashing severe warning signs.
The UK is facing the most severe stagflationary shock in 5 decades. Their reliance on imported natural gas caused their borrowing costs to explode. The 30-year gilt yield soared over 5.5%.
And the downstream effect was brutal. UK mortgage lenders literally pulled over 1,500 different mortgage products off the market in a single month. They just stopped offering loans because the math was too volatile.
Europe isn't faring much better. They face rapid deindustrialization because heavy industry can't operate with these elevated energy costs. Plus, Iran fired advanced missiles demonstrating a 4,000-kilometer range.
Meaning every major capital in Europe is now within direct striking range. And we also have to highlight Dubai as a loser in this shift.
Right, their neutral oasis brand is shattering. 90% of Dubai's population is expats. But because of the proximity to drone strikes and regional instability, that highly mobile population is packing up. The capital flight is massive.
When we zoom out to commodities as an asset class, the U.S. government now officially classifies 75% of the periodic table as a critical material. But the most revealing price action is happening with gold. During a geopolitical crisis, you'd assume Western institutions would be panic buying gold.
Right. But they're aggressively selling it. We're seeing massive outflows from Western gold ETFs. That's why margin calls. These institutions are highly leveraged in stocks and private credit. As those freeze up, brokers demand cash. They are forced to sell their liquid paper gold ETFs just to cover their bad bets elsewhere.
But while the West liquidates paper gold, physical gold bars are relentlessly flowing east to Asian central banks. Although the sources note the Gulf states might actually stop buying gold.
Because they have a desperate need for internal liquidity. They have to spend hundreds of billions repairing the domestic energy infrastructure that just got destroyed by missiles. You can't rebuild an LNG plant with gold bars.
And looking at digital assets, the sources argue we're entering a debasement trade supercycle. Historically, gold pumps first as a safe haven from fiat debasement. Then, as liquidity sloshes around, Bitcoin and crypto follow as the newer digital alternative. Let's just pause and appreciate the absolute poetic irony of this macro situation.
Oh, it's incredible.
For decades, military strategists assumed defeating the U.S. would require a massive conventional military buildup. But the reality of asymmetric warfare is completely different. The ultimate weapon against the U.S. isn't military, it is financial.
Exactly. You don't need to defeat the U.S. Navy. You simply exploit physical choke points to make the fundamental inputs of the economy, diesel, fertilizer, helium, so prohibitively expensive that the U.S. consumer breaks under the inflation.
Once the consumer breaks, the Fed is trapped, the bond market revolts, and the over-leveraged stock market collapses. Economic warfare executed through physical bottlenecks. So knowing all this, how are the professionals actually allocating their capital? The sources detail Michael Pento's portfolio strategy, and it's our third actionable takeaway.
Pento's allocation is shockingly defensive. He's holding 70% of his entire portfolio in ultra-short-term T-bills and cash equivalents.
For an active money manager, retreating to 70% cash is just staggering. Why hold cash while inflation eats its purchasing power?
Maximum optionality. He accepts the slow bleed of inflation because he wants unencumbered liquidity ready to deploy the moment the credit bubble bursts and asset prices crash to realistic valuations.
And the remaining 30%?
20% is allocated to physical necessities, commodities, agriculture, precious metals, energy, 3% to defense equities, acknowledging global rearmament, and 2% to strategic short positions against the weakest parts of the stock market.
It's a wartime portfolio, built on the premise that the passive gains of the last 40 years are permanently behind us.
The macro environment has structurally inverted.
Which brings us to the core realization of this deep dive. We started by looking at the pristine digital X-ray of the stock market, the algorithmic taco theory, the zero DTE options. It all looked so engineered and detached from consequences.
But the digital X-ray was completely ignoring the brutal physics of reality.
We've moved from the illusion of algorithmic control to the unforgiving reality of shut-in oil wells, empty fertilizer shipments threatening the food supply, exhausted consumers, and private credit shadow banks trapping investor money.
The physical world has unequivocally reasserted its dominance over financial engineering.
And this matters profoundly to you because the investment landscape of the next decade will not reward the passive buy-the-dip indexing of the last 40 years. We are entering an era defined by physical constraints and sticky inflation. Let's restate those top takeaways with the full context now.
Right. First, traditional 60/40 portfolios fail when structural inflation forces stocks and bonds to fall together. Second, audit your private credit exposure because mark-to-model valuations are a black box hiding real losses. And third, prioritize physical commodities and absolute liquidity for optionality.
As always, this is analysis, not advice. Talk to a qualified professional before making changes to your portfolio.
And, well, that leads to one final critical thought. For the last 4 decades, the global economy operated on the assumption that having digital money meant you could buy whatever physical goods you needed instantly from anywhere.
Right.
But as we watch infrastructure burn in the Strait of Hormuz and shadow banks gate their withdrawals, we have to ask ourselves, what exactly happens to the value of our digital wealth on the day we finally realize we cannot print the physical reality required to sustain it?
You cannot print reality. That is the ultimate takeaway. Thank you for joining us on this deep dive. Keep questioning the algorithms, keep paying attention to the physical choke points, and we will see you next time.